Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Dallas and Michael here today. The topic that we've got, Michael, one of yours, is with structure comes freedom.
Thanks, Dallas. Yeah, so I thought we would talk about our suggested method for effectively meeting your living expenses and also funding and seeding your future retirement savings.
I like the way you've taken. See, that sounds horribly boring, but if we've got a title like "With Structure Comes Freedom," you're creating a hook there where people go, "Wait a minute, what does he mean? Where's the freedom come into it?" And so, I think that's a great one because people automatically think of budgeting or managing their cash flow as this horrible thing that someone's going to sit them down and make them.
They do. So yeah, so they. I mean, it hurts people's head to think about doing a budget.
Yeah,
and we're not talking about doing a budget. No. We're talking about ranking.
Yep.
Really ranking your allocations of your income.
Yep.
And so it'd be interesting to get your take on this. So this is what I think is the best way to do this.
Yep.
First of all, as a minimum, it's different for everyone, but as a minimum, look, we assume that we want each individual person, whether you're a single person or whether you're a member of a couple, we want each individual to meet their full $27,500 contributions to superannuation each year. Mm-hmm. And just to be clear, the $27,500 concessional contributions are the sum total of money that's going into superannuation that will be claimed as a tax deduction. Now, that does include super guarantee contributions.
So your employer contributions.
That includes your employer contributions. Any top-up from your employer is included in that because they're claiming that as a tax deduction. Any salary sacrifice contributions. But also further to that, we speak a lot about personal contributions to superannuation. So that's after-tax contributions.
Yep.
That we then allocate as a concessional contribution, aka we claim those contributions as a tax deduction at the end of the financial year. So we'll give an example here because you're probably listening now thinking, I'm not too sure exactly what he's talking about.
And the reason, just to jump in, the reason why you're saying this is sort of normally your first cab off the rank is because this is the real low-hanging fruit. Like everyone comes in and says, we know we want to sort of get set up for our retirement And whenever you say, do you want to do that in a tax-effective manner, people look at you like you got three heads. Of course we want to pay less tax. Of course we want to manage that if at all possible.
That's right. And so I'm starting with the premise that we're starting from the premise that each person wants to maximize their $27,500 contributions each year. Yeah. You may need to do more than that to get to where you need to be.
Yeah.
You may need to do less than that.
Yeah.
It's a nice one, Dallas, because we talk about the double tax whammy here, and this doesn't exist in many places. So that $27,500 contribution to superannuation is a double tax whammy in that we get to lower our personal rate of tax, and most people are on at least 34.5% rate of personal tax. We get to lower that to a 15% rate of tax on the contribution to superannuation, and then after 60 and meeting condition of release, which would be retiring or ending a workplace arrangement, we get to actually access that money tax free. So not often in our tax law, usually if something's tax deductible on the way in, it's fully taxable on the way out, or vice versa. In this situation, there's a tax deduction or a tax lowering, let's say. It is a tax deduction on the way in, and also tax-free on the way out. So I'm starting with that premise. So what I mean there is that if you're a single person, we're starting with the premise that the first of your income that comes in, if you get paid weekly or you get paid fortnightly or you get paid monthly, all that income that comes in every year, we want you to add on to that. In this example, this is not advice, but we want you to add on to that and get your super contributions up to $27,500 because that's the concessional contribution allowable amount. Now, without opening too much of a can of worms, depending on your situation, you could actually tap into what's called as the concessional contribution carry forward contributions as well, which means your contributions, your claimable contributions could be more than $27,500 per year for a catch up period. We've done podcasts on that in the past.
And that's I think the thing where, like, I guess if you think of it as the order of how we think about this or how you think about this sort of makes sense because you go, you're right. Most people come in and go, I assume that I want to maximise my retirement savings and I want to minimise my tax. That's the thing. That's normally the first lever that you pull. And off the back of that, there's other things to look at. There might be and this assumes a couple with both working or a person with that's on a decent income. If you've got lower incomes, that changes. This isn't designed to fit all sizes. This is the typical sort of thing that we see. And I think that's a good point. Like the carry forwards, for a lot of people, there's some there to do. It might be a lot, might be not much, and that's a separate issue. But that's normally the first lever that you're pulling is to go, hey, if we can do this, that will make a big impact over the next 5 to 10 years. That last 5 to 10 years of your working life. So
the example I'm going to use here is for a couple, but like I said, if you're single, just halve it. The example I'm going to use is that we have two members of a couple. They're both working, and they have employer contributions of $12,500 each going in per year to superannuation. What that allows them to do is actually, I'll actually let me assume 14.5 to make the
numbers stack up neatly.
They have $14,500 of contributions go in each year. What that allows them to do in this nice, simple example is both put in $13,000 a year to take them up to $27,500 per annum. I'm going to assume they get paid fortnightly. What the first allocation of money going anywhere, so as their pay comes in fortnightly to a bank account, our first ranking or priority would be to say if you can be paid $500 each into superannuation as a personal contribution, and what that would be is from an after-tax source, so it's from their after-tax pay. What that adds up to over the course of 12 months or 26 fortnights is $13,000 each that's gone in.
Brings them up to that.
So what they're able to do is their employer contributions of $14,500 each in this example, plus their $13,000 of personal contributions at the rate of $500 a fortnight, get them up to the $27,500. They can then complete a notice of intent to claim a tax deduction on that $500 a fortnight that's gone in. And what that does, differently to salary sacrifice, where the tax deduction is claimed every fortnight, it allows them to claim a $13,000 tax deduction at the end of the financial year. Now, that translates through, because in this example, both members of this couple are claiming $13,000 each. We assume they're on the tax bracket of between $45,000 of assessable income and $120,000 of assessable income, which is a big tax bracket. It's their biggest tax bracket that most people fall in, and they're in a 34.5% tax bracket. Now, what actually happens then is they're each claiming $13,000, and you claim that at your marginal rate of tax. So they're claiming that at a 34.5% tax bracket. So the simple calculation is 2 times 13,000, which is $26,000, at a tax deductible rate of 34.5%. And what it means is they get $8,970 back in their combined tax return.
An extra refund. So
now, sorry. I was going to say we'll talk more about spending that later on. But it's what what we like. There's most people we see have a lump sum expense that crops up out of the blue every year.
Yeah.
Now, whether that's something that breaks around the house, something that breaks on their own body that they need fixed, something that breaks on a vehicle or something like that. So we like to claim the contribution for our clients at the end of the financial year. The reason being is that they actually get back a lump sum. In this case, they've done the hard work by putting in $500 a fortnight each. They could have salary sacrifice money in, which would have claimed the tax deduction at the payroll level.
Yep.
And what it means is you don't get that big lump sum at the end of the year. But in this case, our preferred method, Dallas, is to actually claim that at the end of the financial year. So they're getting back a meaningful amount of money, $8,970 in this example, to actually do something with.
And it's interesting you say that, because it is fascinating to me how often this exact thing happens, and I think that ties into your title with Structure Comes Freedom, is that it's amazing how often that $9,000 extra tax refund comes in at a time where people, like you say, people are going, this thing's happened that we need to replace all the air conditioners, or I need to have knee surgery, or I need to, our son or daughter's just got married and we're paying for this, or something's come up where they go, geez, that $9,000 comes in handy. And I don't know. And we've, the theory here is that if you don't do that, if you don't have that structure, if you don't have that, I guess, approach throughout the year, you're sort of giving up a little bit over a while, and you sort of don't really notice it. And then at the end of the year, when you get that lump sum, invariably that's when something goes wrong, as something not goes wrong, but there's something that pops up that you couldn't have allowed for. There's a lump sum there that you can go and grab and go and do that with. And if you don't do that, you're looking for $9,000 or you're looking for $10,000, and it doesn't. And it's at the end of the calendar year, and that's where, I don't know whether it's the timing thing, but it comes up. People go and do their tax. They get that lump sum in sort of September, October, November, just at a time when they go, oh, geez, the air conditioners aren't working, just coming into summer. Okay, we can go and replace that. If they don't have that, that $10,000 has got to come from somewhere. They've got to find it, and it becomes then you're sort of playing catch up leading into the end of the calendar year, and it's just a burden.
So you mentioned before, Dallas, also in a previous podcast, and that was the podcast was called Beware of Living Out of Your Home Loan. That's what we call it anyway. So like we said, sometimes they get renamed. But you talked about paying yourself first.
Yep.
This is an example of paying yourself first.
Yep.
For us, and we'll talk about the tax deductibility point of view a bit, we'll burrow down into it a bit later on. But for us, the best tax deduction is for something that you're going to get back tax-free later on.
Yeah.
So
which is exactly why, like we were saying, that's that first lever we pull. It's not to say that that's the only amount of money that you need to save or anything like that, but it just is to go, that's such an easy thing for people to get their head around, where they go, I am putting aside $1,000 a fortnight now.
Yep.
And I know that it is going directly into my super fund. It is growing. It's going into a tax advantage environment. It's compounding. My money's getting dressed and going to work for me, as you would say.
That's right.
And I know that when I get to retirement, I'm going to pull that money out completely tax-free. And along the way, I'll get to the end of the calendar year and I'll have a $9,000 tax refund.
Yep.
It's very easy for people to get motivated and get excited for that. When we then get into, which we will talk about, the framework of extra loan repayments, even extra after-tax contributions to super, they're all very important, all very relevant, and you may well need to do some combination of all those things. But it's harder to go, right, that's a lever that we very clearly need to pull, whereas these contributions are one where you can just go, it's very hard to find a downside for most people.
That's right. So again, why this is our first priority. So our first priority is getting our clients up to $27,500 per annum. If we take the $26,000 that we're talking about here, so $500 a fortnight for each member of a couple, it's $26,000 for the year. We just spoke about that money going into superannuation, them claiming that as a tax deduction at their marginal rate of tax, which happens to be 34.5%. It's the biggest tax bracket that we have here, where most people fit in. $45,000 of total income up to $120,000 of total income is that 34.5% tax bracket. They claim back $8,970 in personal tax deduction at 34.5%. Now that money, that $26,000 does get taxed when it goes into super, but the tax rate is only 15%. So we look at an arbitrage event here and we say, okay, I'm putting money in, I'm claiming it at 34.5%, and I'm paying only 15% tax on the way in. That's free money, and we love free money here. It's 19.5% free money.
Yeah.
We could do something else with that $26,000.
Yeah.
We could put that off our mortgage, which is a very valid thing to do. It's not tax deductible. We could finance a very expensive car that's tax deductible for us, but hey, it's into a depreciating asset that's going to drop in value, not grow in value for us.
Yep.
So what we look at is our number one priority there is, before looking at allocating any other money, we tell our clients, pretend that one of you just had a move to a lower paying job or whatever reason. You've got $1,000 less in this example per fortnight. People adjust really quickly if they move from full-time work to 0.5, they adjust really quickly. So this is just an adjustment down and saying, okay, well, you're going to pay yourself first. You're going to pay, between this member of the couple, you're going to pay $1,000 a fortnight into superannuation. Notwithstanding, you're going to get back nearly a bit over 1/3 of that when at the end of the year, when you do your tax return, you've actually got the money going into an environment that's going to come back to you tax free at a stage in the future.
Yeah, and that's exactly my point around that motivation thing. It is if someone had said, "Hey, I've been offered this job. It's a lower paying job, but it's something I'm really excited about, really passionate about." Like you said, people would find a way. They get motivated for that.
Yep.
And this is what we find. This is one of the few savings that people do tend to get really motivated for in the same way, because, like we said, it just ticks a lot of boxes the whole way down. It's not a huge amount of money for most people. It's sort of easier to find. They know that, right, if I do this, I can see the impact that's going to have over the next 10 years. So I'm motivated by that. I know that I'm going to get that lump sum as a tax refund towards the end of the year. I'm motivated by that. And so it's a combination of those things where, like I say, this is where I actually think we should turn this podcast into a 2-part series, because the other levers that you can pull, they're around after-tax contributions, extra home loan repayments, savings to a cash account, any of those sorts of things. They're all great, and they're all really important, and they may well need to be done dependent on how much you're looking for in retirement. But this is just one where it's almost the low-hanging fruit, I would say, for most people.
Well, I've got some things. I do like that idea of comparing different things, like in the future. But I've got. If we go to priority number 2, so cash flow priority number 1, we would say getting each individual's super contributions up to $27,500 in total for each year. Including what your employer puts in. So priority number 2, bills that you know are going to happen, that are going to come in. You want separate bank accounts. We are big fans of, Dallas. Now, if you have a mortgage, most banks actually give you the ability to have multiple offset accounts now, and which is great, because one of the simple things, the simple triggers that we simplification works for people, and if you can nickname an account bills account,
it's very hard to.
It's very hard to get it confused with your other hypothetical account. It's your holidays account. So bills account, this does require people to do a budget and to add up the annual, but I guess
very high level.
I guess. And then add a 10% variance to it is way better than not having something. For example, I would say go through all of your and looking to the past is the best glimpse to the future. So if you went through and looked at your last 12 months worth of expenses, and you can download that now with bank accounts, looked at how much your rates were, how much your insurances all were, how much direct debits are coming out of accounts and all that sort of stuff. Added all that up, made that an annual figure, and added a 10% variance to it, you opened a new account or renamed an existing account, your bills account, and you divide that annualized figure with a 10% uplift by the number of pays that you get. So if you get paid fortnightly, you divide that figure by 26, and in this example, let's say that comes to $1,200 a fortnight. What you would do from as your second ranking of dispersing your income is each fortnight when your income comes in, you've made your super contributions that we talked about first. The second one that you want to do is to push that into the bills account. Now, what that does is it pretty much guarantees that you meet all of your bills for the year. So that bills account will ebb and flow. There'll be times because of the frequency of things like council rates and annual home insurance and all of those types of things, which come out once a year for a lot of people. There'll be times when that bills account gets up to $10,000, $11,000, $12,000 before inevitably you get hit with a series of bills, which drops the account balance back down from $12,000 to $2,000. What's important is to never, ever rob that bills account. So you can rob your other accounts, your discretional spending accounts.
Rob your holidays
you can
account.
never rob the bills account. It always it strikes me as a strange thing that people forget every year that their rates and their home insurance is coming up, and it's an amount of several $1,000s for each one of those.
I think there's probably a component of like the ostrich with the head in the sand. It's like if I just look away, maybe my local council will forget about me and they won't send me a bill. No, they're very good at it. They are going to get you with that bill every single year. That's going to happen.
And even if you because we know now inflation is rising, and if you've added a 10% variance to that, sometimes that doesn't allow enough. Like, so the next 12 months of expenses are going to be a little bit more than they were in the last 12 months, perhaps. At least you've actually done 9/10 of the heavy lifting in that situation. You're only scratching around for $1,000 here or there if your expenses are more than that. So there's two big allocations of money. Now, beyond that, you can have any number of other bank accounts that you want. You could have a holidays account where you actually put a fortnightly amount of money in there so that you've got a big lump sum towards the year. Not forgetting that in this example, by claiming your after-tax personal contributions to the super fund at the end of the financial year by completing the notice of intent to claim a tax deduction form, you'll in this example, this couple is getting back $8,970 of tax returns as well that they can spend as they please. But so really our in summing up, before I'll throw to you, Dallas, if you have anything to add, but number one, if we looked at your fortnightly income coming in and your weekly income coming in, we would start with the premise that every individual, whether you're a single person or two individuals as a member of a couple, wants to get this concessional contributions to super up to $27,500 per annum. So that would be the first ranking of where you want money to go. The second ranking would be to go into a bills account, to set up a separate bills account. Practically, look, it helps to have direct debits come out of that bills account as well. So if you have your Netflix and your like whatever you have coming out as a direct debit, you'd have it come out of that bills account because that's the account that you want any direct debits meant from. Makes it also easy in the next 12 months to review that account as well. You can just do a 12-month download of the figures and look at what the expenses were coming out of that bills account. If you have to pay things via credit card, like whatever you're paying, you can just repay back the credit card by a transfer out of the bills account. So if you paid your home insurance and it was $3,000 from a credit card, for example, you just pull $3,000 out of the bills account and put that on your credit card. So that's our suggested. Included in the bills account would be your mortgage repayments too. If you're still paying a home loan, we think that's something that makes sense to actually have that. Well, I think it's something that makes sense to have come out of there because it's now whatever you have left over in that situation after you've made your super contributions and after you've made your expenses is free money.
Yeah.
It's free money.
Yeah.
So, like, if you blew all of that money, if you spent all of that remaining money,
you'd go at a bare minimum. I've got a roof over my head, and I've been doing something for my retirement.
Yeah.
Well, I think,
and that. Sorry, just before I forget, most people think that's an onerous thing, but when we structure things like that for our clients, they actually say, "This has given me so much freedom."
Yeah.
So the structure gives you the freedom because they know then after that, it's stressful for people to work the opposite of that. It's stressful for people to go
trying to be decide.
I was going to put money into superannuation, but I've got rates and car rego this month, so I'm going to have to miss that. Well, we say, okay, well, if you get on the front foot and you have that money in your bills account and you've already put your fortnightly contribution into your super fund, that structure gives you the freedom. Then you're never ever scratching around for money.
Well, I think what I would actually propose that we do here is because that's a really handy, I guess, overview of the rough framework there. I think what I would like to do is do as a separate podcast. What I could do is talk about some of the, because it's interesting with some of the things that you and I do differently.
Yeah,
it's just a thing that you develop over time where I sort of approach this in a similar way but slightly differently. And so what I might do is, if we call this With Structure Comes Freedom Part 1, and this is the Michael version, and then we do a Part 2, which is my version, which is, again, similar. It's all about, for both of us, the overarching thing here is, everyone wants freedom. Everyone wants to not have to stress and worry and to feel like they're not, under pressure. The only way to get to that freedom is through the structure. And so this is your framework for how to get.
Yeah, and I'm certainly not saying that it's the best way. It's a way that
it works.
That has worked for me and it's worked for my clients. Yeah.
And that's also what I might do is we do a separate podcast, which is my sort of structure that I tend to approach this with my clients, which will be similar but different in other ways, and some things will resonate with different people. But and again, the overarching concept, which is the same, which is that until you have some structure, you have too much freedom in that every day, every week, every fortnight, you gotta go. There's a lump sum of money there. I got bills coming up. I've got a bill coming up. I've also got a holiday coming up. I want to do something fun this week. I want to save for my retirement, and you got to make that decision every week, every fortnight. And it's just too hard, and that's not how our brains are wired. What we're actually wired to do is sit down, think about this rationally, work out a framework, work out a structure, and then know that off the back of that, I can relax and go, whatever's left over there is free money, and I will spend that however I want. My other desires will fight it out for that money, and that's where we'll end up. So I think that's I think this is probably a good place to wrap up for this one, and we'll come back for part 2 another time.
Sounds good.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. For more information and resources, visit the Money Over 50 website, mo50.com.au. We look forward to catching up again soon.